Are you ready to take control of your family legacy and financial future? Howard Kaye and his experienced team have been helping families and business owners coast to coast with their most important financial decisions for more than 60 years. They have the proven strategies you need to grow and protect your wealth and family legacy for generations to come. Whether you're focused on wealth creation strategies, planning for guaranteed lifetime income, selling an existing life insurance policy that's no longer needed or wanted, or simply leaving a financial legacy for future generations, Howard Kaye has the resources to guide you every step of the way. Howard and the team at Howard Kaye Insurance Agency LLC want you to live a rich life that's well planned and tailored to your dreams. Live Rich, Die Rich starts now.
It turns out when it comes to your money for retirement, what you don't know could hurt you. But today you'll learn cutting-edge financial strategies and tips on creating income and additional wealth for life in retirement, and how to avoid missteps with your finances. Welcome to the program, everyone. I'm Amy Sharp, and joining me, Howard Kaye and Tony Scuderi with Howard Kaye Insurance Agency. And Howard and Tony, it is always good to be back with you guys. How are you today?
Great to be here. Thanks for having us again.
Very pleased to be here.
Okay, we've got a great show for everyone. Many of us look forward to retirement, and rightfully so, because I think the mindset is that we've done all the work. We leave that part behind, and now is the easy part. But I have a feeling that you're going to tell us a little differently about that, a little different way to think. What can we expect when we get to that stage of retirement?
Well, what I like to say to people is don't wait until you get to that stage of retirement, because sometimes it's too late as far as the proper planning goes. In fact, the other day, one of our people in the office had come to me. He's 60, I think he just turned 65 years old. And he said, I just want you to take a look at everything that I've done, that we've helped along the way. He goes, I think I've done well for myself getting into these next years ahead. And I said, well, that's because we've been planning every 5 years. When you were 45 years old, we started and we kept going, and so on and so forth. So when I say that the biggest mistake somebody can make is waiting until their retirement, then the question is, have you planned? And if you haven't, then what do you do? And that's where we may have some answers to help out. But certainly Tony, who, gosh, has been doing retirement income planning for what, 40 years now?
42.
42 years, has some definite insight on this.
Yeah, Amy, I think part of the issue here is that for the most part, the people we meet, they may have a team of experts. Unfortunately, there's not always coordination between them, and not enough of them focus on income planning and legacy planning. They might sell life insurance, but there are thousands of licensed life insurance agents. But you really need an integrated type plan that takes into account the steps you've already taken, or perhaps the steps that you haven't taken that you really need to consider. So when we have clients come in for a review, whether it's a retirement planning review or a legacy planning review, we're going to take into account all the steps they've taken. We'll have them bring their documents. If they want to talk to us about their trusts, their life insurance policies, their annuities, their 401k plans, we don't advise them on investments. That's not our role. But we do need to understand what steps they've taken so that we could give them some guidance going forward.
It sounds like both of your insights can be so invaluable to these individuals coming and meeting with you. A lot of times people maybe think, I could do this on my own. I had a budget my whole entire life with my working years. But when you get to retirement, there's just so many other things. Having insight from a trusted advisor is got to be so important.
Absolutely. I find that there are those like you just described that do feel that way. I think it's also a level of what kind of wealth you have, because somebody who has been on a very steady income their whole life, who has had a retirement plan with their job and a pension and knows exactly where they're going to be, is one group of people. Then you've got another group of people, let's say the entrepreneur out there, who has always fended for themselves, somehow has made it, made a lot of money, and maybe they put money away, maybe they didn't, but the point is they never have that fear of running out. It's not a valid thing because they will be in that problem. So what we like to discuss as a an advisor to them is, I'm not interested in investing your money. First of all, I'm not a registered investment advisor, so I can't do that. But I want to show somebody how we can take a small piece of the pie, so to speak, and diversify, reallocate things. And this small amount of money is going to put you in a position to create, based on what you believe markets, indexes, things like that are going to do, is going to satisfy your income needs so that all the other money that you keep and invest however you want to do it, with your investment advisor, by yourself, whomever it may be, would be icing on the cake, so to speak. There's more. We want to make sure your baseline, the foundation, is met, that you are covered no matter what.
And one thing, if I can add, Howard, DIY, this whole do-it-yourself craze, this is one area you really don't want to venture into with that mindset. With the advent of the internet and everybody becoming their own expert, a lot of folks think they can sort of cobble together a strategy that's going to work for them. The truth of the matter is you do need professional advice. A lot of folks are in programs or investments that are either way too high of a risk profile for their age and their risk tolerance. They have underperforming assets. They have assets that are idle and not performing. That's where Howard's talking about reallocating a portion of the assets to create a lifetime income, to create a legacy, to help clients ultimately achieve everything they want to financially.
Yeah, so as we talk about what to expect in retirement, what we shouldn't expect is that we can probably do this on our own. And I think that's good to know. It's good to hear from two people that talk with individuals every single day for many, many years, like you said. 20+
Absolutely.
years.
And the one thing also that I would say, there's always one thing, but in this case, I don't know that people necessarily know the right questions to ask. And when we go through this interview process of just discussing what they've done, what they've set aside, what are their visions, that's where a lot of people will say, I haven't thought about that. And that's where we can bring everything together and really help someone's situation.
Howard, Tony, thank you so much. And up next, how can you tune out some of the negative headlines and financial noise? And later, Howard and Tony answer your questions. That's straight ahead. Stay with us.
Everybody needs a plan. If Carol's ever going to retire, she needs a plan. So does Bob, if he ever wants to catch a break. Jim and Susan, they need a plan to keep the beat going. And Puddles over there? Yeah, he's going to need a plan too. You? Yeah, you probably need a plan. Whoever you are, whatever you do, you can use a plan for retirement. We can help.
Glad to have you with us on Live Rich, Die Rich. I'm Amy Sharp, here with Howard Kaye and Tony Scuderi of Howard Kaye Insurance Agency. And I'm sure you know people here in South Florida have a lot of information that they're sorting through, and it's coming from everywhere, thinking about retirement and estate planning. And it gets to the point where you kind of have to think, how do I cut through all this noise that's out there and really focus in on what I need to know?
Well, it comes down to, first of all, you're right. I mean, you go open your mailbox and you've got invitations to every different seminar, especially here in South Florida, workshops talking about retirement planning and annuities, and then moving into estate planning with life insurance, all of which things that we love and recommend. But it's understanding when to recommend and why you're recommending it. People sometimes get confused with, what is estate planning? What is retirement planning? And estate planning is really a function of putting your affairs in order so you've designated exactly what you want to go to whomever you're leaving that to. If there is a way to avoid estate taxes, we look into that as well. But it's really designating that estate. What's retirement planning is setting yourself up for yourself to enjoy the benefits of your retirement by not working and having enough money coming in. So it's showing different ways of doing that. Now, whether we talk about, and I know we'll get more into this later with annuities because it's a hot button for me. Why? Because you hear people saying, I hate annuities, or you don't want to buy annuity. People take conventional wisdom They don't understand what they're saying. They heard somebody else say it, and they follow that path. Let's forget what we call anything. And let's just look at the facts of when I show you how to take X amount of money to create Y amount of income, does it really matter at the end of the day what we call it? In fact, I can go so far as to even discussing an insurance approach that we created called the 401k plan. Now, it's not your typical 401k. This is 401k-A-Y-E.
Okay,
Get it?
I like that.
Another term for it is create your own inheritance, where I'm showing somebody in their 40s or 50s how to create an inheritance by buying life insurance on their parents. Something that they never would have considered. But the truth of the matter is the parents are supposed to pass away a lot sooner than the younger people. And if you're going to be in retirement years when your parents do, let's face it, your parents want to help their children as much as they can. But as long as you're not a financial burden to them, well, you're not. You're buying this insurance. You're just asking to borrow their lives so that you can have this insurance to create more money during retirement. Again, just looking outside of the box, and this is why it's so important to really have meetings with people and share everything that there is.
Basically it's about what we do, creating and preserving wealth. So we're always looking for out-of-the-box strategies, different methodologies to create and preserve wealth. And purchasing insurance on the parents is not as odd as it may seem. While some folks may need to be coached on how to approach their parents, as Howard pointed out, if it's not a financial burden and it can bless the children and the grandchildren, most parents are very agreeable to it, and it can wind up being quite a sizable sum. Not only that, when Howard mentioned annuities, if you have a properly structured annuity that creates adequate income, it can actually help preserve your other assets to help leave a larger legacy. In fact, some of those annuity proceeds can go towards a life insurance premium to create huge amounts of tax-free wealth. But most advisors are not showing clients how these products really work together to create massive wealth and ultimately comfortable retirements. And that's what we try to do when we have our review with clients.
Well, and I think about the things that we need to know when it comes to retirement, estate planning. Listening to you both talk, you can't just rely on the water cooler information that you're getting. You can't just rely on what you heard on the news. And that's easier said than done for some.
Oh, absolutely. In fact, we use a lot of charitable strategies as too. Growing up, my family was very philanthropic, so I always learned the more you give, the more you receive. And it's just so true in life. And you give because it feels good. You want to give. We've shown so many people how to create huge monies for charity that are all part of their retirement planning and their estate planning. Now, you might ask, how can that be? Well, there are certain charitable giving opportunities that allow you to give money to an organization that will give you an income for the rest of your life, and then the remainder of that money goes to the organization. Or you can structure it where some monies can come to children. But also, we've shown people how to give their estate away twice. I'll never forget, I was at a charity meeting, a luncheon one day, and they're talking about, basically for 2 hours, the attorneys were saying to the audience, you should be giving all your money to the organization. The woman gets up and says, well, I'm not quite sure I understand. You mean for 2 hours? All you had to say in 5 minutes, give us your money. I don't want to. I said, I have an idea for you. What are you worth? She says, $10 million. I said, and how do you invest your money? Well, these days it was all bonds, 6%, $600,000 a year. I said, what do you live on? She goes, $140,000 a year. I said, the first thing you need to do is get a raise. Spend more money. Enjoy your life. What's the money for? I know, we're from the Depression, so on and so forth. Any event, she says, but I'd love to give to the organization, but I don't want to leave my kids out. So how can I accommodate this? Very simple. You're worth $10 million. And these days, the exemptions were $1 million a piece, husband and wife. That's $2 million. I said, take $2 million, you'll be worth $8 million. Instead of 10, the $2 million is going to buy $10 million of insurance on you and your husband. That money goes to your kids, tax-free. And the remaining $8 million, which is going to grow, will go to charity. I've just given your $10 million estate away twice, and that was estate planning, it was retirement planning, everything came in, and it was charitable planning.
And she's still okay.
And she's still okay and still living.
Love this story. All right, thank you guys. Great insight. Up next, Howard explains a strategy you might be overlooking: life settlements. That's straight ahead in dollars and cents. And later, Howard and Tony tackle some of your biggest retirement questions. Stay with us.
How much do you have saved for retirement? Now, cut that number in half. That's the impact inflation could have. Think about what that could do to your lifestyle and spending power in retirement. Inflation is on the rise. How can you protect your retirement dreams? Start by getting this free guide to understand inflation and the 5 easy steps you can take to help keep it from downgrading your retirement. You can't stop inflation, but if you act now, you may be able to minimize its impact on your retirement. Get your free copy now.
There are a lot of strategies you might be overlooking when it comes to your retirement. One strategy to consider: life settlements. Howard?
Thank you, Amy. On Dollars and Cents today, life settlements. Many of you are familiar with the term. You've seen advertisements all over television from various companies talking about life settlements. Let me give you a little history and really take you back to where this all came from. Many of you may be familiar with the term viatical settlements, because that's really where it came from. Back in the 90s, you had, unfortunately, people that were suffering from AIDS and needed money to cover their medical expenses. So investors came in and offered to buy people who were suffering with this terrible disease money for their life insurance policy, knowing that these people had a life expectancy of maybe 6 months or a year. So somebody might have a $50,000 or $100,000 life insurance policy, and somebody would come in and offer to pay them 50%, 50 cents on the dollar, so to speak, for that policy. And they loved that because they needed that money, like I said, for their medication. Well, it turns out, as a result of this, the medication was starting to work for people. So investors that bought these insurance policies found that the people were not terminal as they thought they were, and people started living 2 years, 3 years, 5 years, etc. Now, it may not have been the best deal for those investors initially that bought into these policies, but that was really the advent of the life settlement market. Big hedge funds, institutional hedge funds all over the world realized that this was an alternative space of investing. It was non-correlated, had nothing to do with the stock market or with the bond market or anything else. This had to do with a life insurance policy, the life expectancy of somebody at that given age, and usually we're talking about people that are 70 years and above because they have more of a shortened life expectancy, and what the premiums are for an amount of death benefit, which is their life insurance policy. So that's how we transferred into this life settlement space. Now, a lot of information about life settlements, because like I said, you see a lot of advertising, people can call a number and they'll give you a quote, but remember, the goal for the company that's buying it is to pay the least amount of money. You, for the person that are selling their policy, want to receive the most amount of money. So what is involved in the negotiation process? What is the right way to go about it, etc.? Well, the first thing that's done is we gather all of the medical records for the past 10, 20 years even. The idea is to get as low of a life expectancy on paper. That doesn't mean that's when you're going to pass away, but a low life expectancy, because the lower the expectancy, the sooner, in theory, that the payout of the life insurance policy will be, and those institutional funders can pay more money for them. Next, what is the premium ratio? Well, if I'm dealing with somebody in their 70s, quite often we'll see a premium of roughly 4% of the death benefit on an annual basis. If you're 90, it might be 8 to 10% of what that death benefit is. But again, because there's a shortened life expectancy, the funders are able to pay more for the policy. Now, let me stop for a moment and just say, do I recommend somebody selling their policy? This is not a recommendation. This is an exit strategy over and above what the cash surrender value is in your existing life insurance policy. So for an example, if you said to me, why would somebody sell a policy? Well, very good question. The reason, a fewfold. Number one, you bought life insurance years ago for the purposes of estate planning. You have found that when you bought the life insurance, the exemptions, the lifetime exemptions, were $1 million. Now they're upwards of 13 or even a little bit higher million per person. You say our estate will not be subject to estate tax cost, therefore we don't need this insurance. And we know come 2026 the estate tax exemption is going down, but we're still covered. We still don't have an estate tax problem. So why should we burden ourselves with these premiums if we have other uses for that money? Now, the first thing you would do in that scenario is go back to the insurance company to see what your cash surrender value is. But once we find that out, then we go to the life settlement market and see what they are willing to offer. And quite often, it's 2, 3, 4 times what that cash surrender might be. So if you are already thinking in terms of getting rid of that life insurance policy, the life settlement market is a tremendous alternative. What's another reason why we may look at the life settlement market? It's information, it's data. You know what they say, the more information you have, the better you are equipped to make the right decisions. Well, quite often I'll find if I'm speaking with an 80-year-old, let's say for an example, and they are looking forward to paying more premiums on this policy, and they say, listen, I don't know how long we're going to be paying for. The answer is, before we make that decision, let's see what the marketplace suggests it's worth. Once we see what that number is, there is some taxes. If you get more than what you put into the policy, you'll pay a capital gains tax. If you get less than what you put in, then there is no capital gains tax. But once we see what that number is, and we compare that to investing it the way you invest, along with the premiums that you would have paid to the insurance company, and given that stated life expectancy, how close over that period of time will you end up receiving as much, more, or a little less compared to the death benefit? And in that way, we can determine whether it makes sense to sell. Now remember, I sell life insurance. I love life insurance. But it doesn't mean it's right all the time for everybody in different stages of your life. This has been Dollars and Cents, Life Settlements, something to consider.
Thanks, Howard. Coming up, Howard and Tony answer some of your most pressing retirement questions in our Q&A segment. That's straight ahead. Stay tuned. Welcome back, everyone. Now we want to take some time to answer a few of your specific questions about finances and retirement. And I know this is a favorite segment for you guys. You ready?
This.
Okay, let's do it. Here we go. This one is from Elaine in West Palm Beach. I'm 5 years away from retiring. I've had retirement accounts and I've been saving for years. I've heard a lot about annuities that offer lifetime income. Can you tell me more?
Well, absolutely. Elaine, great question. And that is the crux behind these income annuities. There's a variety of different types of annuities, but we're just going to focus on this income annuity right now. It is the only vehicle that I know of that when your account balance is zero, it will still pay you income. So when you think in terms of monies that you have in the bank or at a brokerage firm or wherever, if you start taking income out, once that account is zero, that firm is not going to send you a check anymore, are they? But every life insurance company that sells annuities will. It's inexhaustible. It's imperative that a portion, just a portion of your money, is moved into these types of annuities because it solves so many problems from that standpoint.
Absolutely. And another point that's often overlooked, Howard mentioned income, lifetime inexhaustible income. That can be joint lifetime income as well. So we can create an income stream that not only creates lifetime income for the person who's buying the annuity, but also for the duration of that person's spouse. In addition, something else worth mentioning, financial advisors tend to spend a lot of time helping clients put together an investment portfolio, and that's fine, we're all for that. And part of that strategy is setting up an allocation that protects against downside investment risk. And we understand and appreciate that as well. But what people don't realize is that money that's put into annuities in the state of Florida and in many other states are protected assets. They're protected against creditors. They're protected against lawsuits. Section 222 of the Florida statute provides for that. So when we take a portion of a client's assets and put it into an income vehicle that's going to create a lifetime income for both that person and their spouse, we're also building a wall of protection around that asset. Because let's face it, it's a pretty litigious society out there today.
Absolutely.
People are looking for that opportunity to sue you for everything that you have. So we want to preserve the asset, we want to create the income, and if we create income, particularly income that increases over time, we have some great annuities with increasing income features, so that you can essentially have a COLA, a cost of living increase, each and every year over the course of your life. Worst case scenario, in a year where the indexes don't perform, you'll stay level. But each time you take an increase, that's your new guaranteed minimum going forward. So your income is escalating over time, helping to preserve your assets and your lifestyle.
Great point for sure. Here's one from Gail in Boca Raton. I'm 55, own a small but successful local business, and I'd like to sell the business and retire soon. I'm still young and will have to pay for health care and other expenses once I step away. How can the business proceeds help me retire comfortably and cover my anticipated expenses? What's the best way to plan for this?
If I may, Howard, I'll address this. I think it's important, again, knowing in advance that somebody's going to retire. You'd rather not wait till the last minute to start to develop these plans. But assuming that person comes to us, in this case, she sold her business, we want to look at what other steps she's taken, take some of the money that she has to allocate towards her financial security, allocate some of it towards an income strategy that's going to create a lifetime income for all of her life or potentially all of her spouse's life. There may be a need, as is the case with many of our annuity clients, that they also, while they want income, want to have some tax-deferred savings where that money is, in essence, a jumbo CD, just for accumulation purposes. Not necessarily earmarked for anything in particular, but something that they want to have access to. And as part of that legacy planning, we're going to see if we can take a portion of the income or the interest she makes on her investments, or maybe her IRA or 401k distributions, and apply that towards a legacy plan, using life insurance to create a large tax-free legacy for her heirs.
And let's not forget, one last thing is a long-term care policy, because again, someone in her position is selling her business for retirement purposes, and she wants to know that everything is, really taken care of. God forbid that she got sick and she didn't have the proper coverage and now is eating into all of her money. Well, that may not fare well for her spouse, and that's why it's so important. So I think we've covered every angle to put her in the best position possible.
Great insight, as always. Thank you, gentlemen. And if you have a question, you can call the number on your screen or visit the website at any time. When it comes to your money and your retirement, it's important that you've considered all the options, including life insurance, annuities, and life settlements in your retirement planning. You've heard a lot of great information today, so why wait? Take what you've learned to help you live rich in the years to come. For Howard Kaye and Tony Scuderi and the team at Howard Kaye Insurance Agency, I'm Amy Sharp, and we look forward to seeing you next time.